Hi, this is Brijesh Dalmia from Masterstroke, and we have a special guest today, one and the only, Bollywood star, I would call him, Kalpen Parekh, MD and CEO of DSP Mutual Fund. Welcome, Kalpen.
Thank you. Thank you everyone for waiting for me on a Saturday evening. So I don't know, आप लोगों के पास, I'm sure better things to do. Jawan movie has got released, but you're still waiting for me. So it is very precious, and I hope I do justice to
Of
the
course, you
next
will.
45 minutes.
Of course, you will. And Masterstroke family is very loyal family. I'm blessed. And every Saturday for last 3.5 years, we are doing this, and people still come, Kalpen. So, and today you are there, so people will come, of course, and we will have a lot of good things to learn from you. And I want to ask you some interesting question, and I hope
Sure.
I will justify your time and the time of my audience. So, Kalpen, first things first, Kalpen. I mean, markets at 66,000. Do you think there is still rally left in the current cycle? What is your fund house view? What is your personal view?
I started my career in the industry in 98. I think Sensex was at 3,000. मुझे 3000 पे भी डाउट था कि कितना ऊपर जाएगा, एंड आई वाज वेरी नर्वस ऑलवेज, और 66000 पे भी आई एम नर्वस. सो इन दीज 25 years there has been no single day where I don't have 5 reasons to believe why market should fall in the next 6 months or 1 year. What I mean to say is that uncertainty and anxiety and likely potential negative news are always around us. And at the same time, businesses and companies continue to operate, grow their profits. तो मैं हमेशा, फिर मेरी जो लर्निंग है 25 साल में, वो ये है कि मान लीजिए कि मैंने अपना पोर्टफोलियो वाया इधर म्यूचुअल फंड और स्टॉक्स 25 या 50 कंपनीज में बिल्ड किया है, जिसमें HDFC बैंक है, L&T है, या बजाज फाइनेंस है, ICICI बैंक है, Reliance, all these good companies of the country. They never wake up in the morning saying markets at 60,000, 66,000, let's wait now and not go to work and not keep building businesses. So मेरा ये मानना है कि as long as profits keep growing over a long period of time, markets will keep rising. The pace of rise can be higher or lower compared to our expectations. In between, every 2 years they will fall by 15%. Every fourth year they'll fall by 30%. Every eighth year they'll fall by 35 to 40%. ये एक standard clinical pattern है, which is like the pattern of seasons, the pattern of day and night. So all this will happen. But I do feel, honestly, I don't have an answer to this. Fund house view ये है कि और जो हमने 2 दिन पहले, जब हम हर महीने की 5 तारीख में एक रिपोर्ट पब्लिश करते हैं जिसका नाम है नेत्रा, it's called नेत्रा, and it is about early signals on either an asset class or a country or certain macros or sectors, where we have highlighted that valuations are richer than what ideally they should be for earning superior returns. Generally, when valuations are closer to 22 times and above, where we are right now, the next 3 to 5 year returns of equity as an asset class are not too different than what you would earn in a bond. So mathematically, पिछले 30 साल में, whenever valuations have been 20, 22, 25, that band, generally it means that the earnings yield of equity is 100 divided by 22, which is roughly 4.5. On this, you can add 1.5% of dividend yield, which means around 6. And it has some amount of growth. Corporate profits grow every year. Versus that bonds are at 7.5. So where we are placed right now, in the near term or near to medium term, we feel bonds and stocks may give similar returns or not too different returns.
Fantastic. One thing which I picked up, Kalpen, is that you started with fear and you started with anxiety of the stock market, that 5 markets will not fall. And this is why I love talking to wise people like you, that you're not always positive just for the sake of it. डर सबको लगता है, जैसे माउंटेन ड्यू का ऐड आता है, डर सबको लगता है, मगर उस डर के साथ आप करते क्या है, this is more important. And I picked up this, that even though you have 5 reasons why markets will not fall, and still you are holding equities, still you are managing funds, staying into equity because you're looking longer term is the key, because डर सबको लगता है. Fantastic. So, Kalpen, you talk about anti-fragile portfolio. I have heard about anti-fragile. I have read the book of Nasib Taleb, Antifragile. I love it. And when you talk about anti-fragile in terms of portfolio, I'm going to scratch your mind. What do you mean by anti-fragile portfolio?
Actually, anti-fragile थोड़ा extremely positive ho gaya. We were struggling for a slightly more realistic word, but my English is not as good, but we just thought we'll pick up this word. But anti-fragile means, I have this glass here. If I drop this, it means, the glass will break. So what breaks is fragile. Whenever something, impacts us, we break. Something negative happens, there is an external force, there is disorder in universe or in markets, you break. That is called fragility. Anything which benefits from disorder, anything which benefits from an opposing force instead of breaking, is anti-fragile. And actually, when volatility happens, mostly portfolios also break. There is no denying, and that's why I said that anti-fragile is a slightly extremely more positive word. But typically, when your portfolio has some asset classes or some investments which behave in the opposite direction when markets break, that makes the portfolio less fragile, ideally anti-fragile. Now, for example, in the last 25 years, Nifty has gone up by 12% at large, and gold has gone up by 11%. And the average of these two is not 11 and a half, as it should be mathematically. Instead, the average of these two asset classes is around 12.8. So, and over 25 years, 0.8% compounding extra is a meaningful delta. More importantly, this number comes with only 65% volatility of either gold or Nifty. So both gold and Nifty have an annual standard deviation of around 18 and 22. Gold is 18 standard deviation. I'm just saying, remember, as a unit, gold fluctuates 18 units annually, and Nifty fluctuates 22 units annually. This combined portfolio will fluctuate just around 11 units, but keeping your returns more or less intact. Now, why this happens is that periods like 2098 to 2003, when equity gave almost zero returns or negative returns, gold went up by 12%. So gold benefited from that disorder. Or period like 2003 to 7, when gold went nowhere, equity went up around 40% CAGR. Stocks went up almost 700% in those 4 years. So that was stocks benefiting from maybe the fragility of gold. So whenever in periods of stress and disorder, something does well. किसी ने बोला है कि दुनिया में हर दिन कहीं ना कहीं बुल मार्केट होता है. It's difficult to only keep changing our portfolios every day to play to that bull market, because on large size it's very difficult, and we most of the times we don't know that there is a bull market till we actually live through it. वो बाद में पता चलता है. So that is, I think, in my view, the concept of anti-fragility. The way I think about investing is, like I said, I'm always cautious and worried, like most investors in the country, which is why they are always in fixed deposits. So, I feel that when in a portfolio you add couple of asset classes which have lesser volatility or which benefit from disorder of equity, it brings a defense to the portfolio. And when there is defense in the portfolio, the longevity of the portfolio goes up. In the last 3 years, post-COVID, when markets doubled, I have felt that there is a sense of bubble in many parts of the market. Now, markets don't care what I feel, to be honest, and maybe even you guys should not. But this is what I feel. For right or wrong reason, time will tell. That there is some fraud in many parts of the market. So I, instead of investing in equity, invested in hybrid funds. And the reason to do that was that if at all markets were to correct whatever 10, 20, 30%, the debt component will allow me to stay put in the equity component. It's a very important nuance. The bonds and gold of my portfolio in a hybrid fund allows me to stay invested in the stocks of my portfolio. I don't know whether I'm able to make sense or not.
Yes.
Left to myself, I may not remain in the stocks of my portfolio because of the volatility or fear of volatility. But the moment bonds or gold or any other asset class which has opposite correlation to stocks, I know that if equities fall, this part will defend me, and hence let me be in that hybrid fund. And uske chalte, at least I made 10-11% of the hybrid fund. I did not make 16% of equities in the last 1 year on that fund, for example. I did not make 4 or 5% of bonds, but I was somewhere in between. Left to myself, I would have not participated only. So that is how I think about reducing fragility of portfolios and trying to be a long-term investor.
Kalpen, another point you made was brilliant, and I'm trying to pick for myself some of the things that you're talking. It makes so much of sense, and I will take a minute here to tell you what I picked up from you. Uh, 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 you see, you made the point that since there was bond in my portfolio and gold in my portfolio, I was comfortable and I did not sell equity. Otherwise, my equity base deta.
Hmm.
This is so there's so much wisdom in this, and this is why people think that equity ज्यादा रिटर्न देता है 20 साल में, लेकिन होल्ड करोगे तो रिटर्न आएगा ना. और
बिल्कुल
अगर आपके पास में सेफ्टी का नेट नहीं है, जिसको बोलते हैं ना
बिल्कुल.
तिनके का सहारा, तो मैं ऑडियंस को बताना चाहता हूँ कि गोल्ड और बॉन्ड तिनके का सहारा होता है, जिसके सहारे इक्विटी आप होल्ड कर लेते हैं कि गिरेगा तो भी कुछ पैसा तो सेफ है हमारा. एंड दिस मेक्स सो मच. सो द रिटर्न दैट यू मेक ऑन इक्विटी पोर्टफोलियो इज ऑल्सो बिकॉज यू हैव डेट एंड गोल्ड एंड अदर एसेट क्लास इन द पोर्टफोलियो. एंड इट्स लाइक मेनी पीपल आस्क मी व्हाई शुड नॉट आई रीड द book summaries rather than the book, and I tell them I've done both. And the beauty of reading the book instead of a book summary is to get these small tidbits which you spoke in your statement today, that why you make more return in equity is just not because of long-term returns, but because you have gold and bond kind of asset class is what you will not get in the summary. Brilliant point, Kalpen. And so, fantastic.
Rajesh, I want to, sorry, I'm interrupting. Another important point is whenever stocks fall, we are bombarded by messages from everyone saying buy more when there is blood on the street, and which is great advice. So I also would do that whenever markets would fall. In my WhatsApp group of my college friends who are all engineers, I would also, put these random quotes because उन दिनों पे तिनका क्या होता है हमारे लिए, ये सब quotes ही डाल देते हैं हम, because
Correct.
there's no other way to,
Correct.
handhold people, right? So many times we think कि कोड डाल देने से एंजाइटी कम हो जाती है लोगों
Yeah.
की, but ऐसा होता नहीं. So one of my classmates, connected back with me after 25 years when I put a quote like this in that COVID period of correction, and she wrote back saying that for last time also in when markets were rising, you gave us an India story and made us invested. Uh, to buy more when there is blood on the street, from where do I buy? I need something which has not fallen. Because if largely my portfolio has fallen, मैं खरीदूं कहाँ से? And my income does not come every day when markets
Correct.
fall. So that was a very big realization for me, that it also means that when markets are very euphoric, it's important to take some profits out into another asset class so that it can be put back to work.
Correct.
And that is the whole thought process.
Fantastic. Really appreciate. So, Kalpen, you're coming out with a multi-asset fund. And I want to ask you, every time there's a new fund offer, every time there is a new scheme, whether it's an IT fund or a defense fund or a BAF or a dividend yield fund or infrastructure fund, and we as distributors are connected with 20, 30 AMCs with 200 schemes being there in the marketplace, 200 strategies being there. And every time the fund house will suggest you should have 5% exposure in this strategy. है तो 100% ही, तो अभी किसमें 5% डालें? So from that perspective,
True.
how will you justify, what are your points which you will suggest to have a very strong reasoning why we should have allocation in a multi-asset fund?
So to be honest, I don't come from that school of thought that just because we are coming out with an NFO, you should invest, or your every client should invest. Novelty is not an investment strategy. Suitability is an investment strategy. So the product has to be suitable to the current context, the current cash flow of your investors, or whatever incremental action you want to do in your portfolio. Again, an anecdotal example: 3 days back, maybe my dad thought I'm I'm launching this NFO. So he told me that, and he has all his money invested in DSP funds, pura invested. He has no extra, cash anywhere. So he said that naya fund hai, thoda, tell me when should I invest and how much should I invest. So I told him, why do you want to invest? So he said, because naya hai. That's all he knew. And then I said, kahan se daloge? Where do you have the money to invest? He said, money is there with your fund. So you take something out from one fund and put it elsewhere. So, I was just learning consumer insights from this, that people think because it's new, there is this eagerness to, put money in. So I would not say that just because a new fund is coming from any fund house, whether DSP or otherwise, merits you to invest money. All I can assure you is that when DSP rarely does large NFOs, we are very, very selective in our product launches. We have one very simple rule that if today when there is a fund launch and if someone were to put a gun on my head and say that, will you put a large chunk of your incremental cash flows right now in this fund? Will you put your company's cash flow in this fund? Will you put your shareholder or promoter's money in this fund? Will you put your senior management's money in this fund right now? If our answers are yes, we will launch the fund. If our answers are not sure, we will not launch the fund. So, keeping in mind certain other operating conditions, either in the world economy or markets, or where things are right now, and those technical parameters I can also talk later on. We do feel that there is merit for us to invest in this fund for our money, and I assume that likewise for all conservative investors who. So there are two types of investors in a euphoric market. Those who wake up every day morning and say 65,000 ho gaya, what next? Markets are rising too sharply. I want to take some money out. Now, when someone wants to take money out, you book profits, you pay tax, you put it in some debt fund, you pay tax again there. You want to bring it back. You may get it back on time. You may not get it back on time. So those who want to time the rally of the market right now, and then let's say even I'm someone from that camp. I want to partly, let's say, reduce my equity exposure. What I will do is I will dial down risk one notch by coming into this fund, because this fund will have roughly 60% in Indian and global equities put together, and the balance 40 will be in bonds and gold. So from 100, for part of my portfolio where I do feel a bit nervous, I can dial down my risk. In investing, it is never wise to be binary about getting in or getting out. It's always better to calibrate. So this fund allows you to calibrate down if you want. For a new investor who says that I am not concerned about volatility, I am a 10-year investor, I am a 20-year investor, I don't care with intermittent corrections, this fund is not meant for them. Such investors you can offer our other equity funds or any other equity funds. But there are enough investors who will say, I want to wait. I will not put in right now. There are people sitting on the fence. And my hunch is that there are more people on the fence rather than wanting to jump in. Or there are more people who may want to book profits right now. And this collective pool is large enough for us to reach out to. If you look at data, if we've been proud as an industry about the fact that 15,000 crores is coming in every month on SIPs, but the net sales for equity is somewhere around 6 or 7,000, which means 8,000 crores of stock is getting redeemed. Now, if that stock is getting redeemed for someone who wants money for a goal or for buying a house, by all means, that money should go. But if that guy is redeeming just because markets are frothy, this could be an intermediate step or a stop where you can park for some time before, if markets were to fall further. This fund will also marginally increase exposure, or you can dial back in another equity fund at the right point in time. Lastly, the need for this fund became more pronounced, around 4 months back when taxation changed. Today, if you want to invest in global stocks, you have to pay your full marginal tax rate or whatever, 20, 30, 40, depending on what tax slab you are in. If you want to invest in gold, on that return, you have to pay your full marginal tax rate. If you want to invest in bonds, you have to pay full marginal tax rates. In this fund, we have deliberately chosen the indexation route of 35% equity and the rest in non-Indian equity. So you get the benefit of indexation and then 20% rate, which effectively comes down to between 9 to 11% tax rates. So, this one product is making three other asset classes tax efficient. Number one, at the outset. Number two, during rebalances, once in 2-3 years or once in a year, if any one asset class misbehaves and drops a lot, or misbehaves and rises a lot beyond its normal rate of return, the rebalancing is also done, in the fund without paying any tax. So there are these powerful advantages that vehicles like this have, and this is not just DSP, but all multi-asset allocation funds have these type of benefits. So I think these are two strong reasons why, for such investors who want to either put in new money and are anxious, or who don't want to stay invested in equity because they are anxious, this fund will satisfy the needs for those investors. Those who want to do SIPs for the next 10 years, 15 years, for them, today's valuations don't matter. Today's anxieties don't matter, because in an SIP of 10 years, the next 1 year installments are going to be only 8% of the total 120 installments. So wahan pe you can just do my equity fund or any other equity fund. But this is a fund for those who want to, take advantage of other asset classes. Lastly, let me also highlight that, Indian investors warmed up to the concept of global investing only in 2020 after COVID, just because last 10-year returns of Nasdaq was, rising like anything. Again, a wrong reason to invest, because most people invest for wrong reasons of past returns. The right reason to invest is future returns, not past returns. We look at someone else's return who invested 3 years, 5 years back. We think वो हमारा है. That is not ours. वो तो जो निकल रहा है उसका है. Now, we believe we are at a point in time, if all of us who have been in market since the last 20 years, we have seen a glorious bull run. Like I said, 3-4 se I'd seen Sensex now up 20 times. But remember, the starting point of Indian markets were 10 P. Today, we are at 22 P. We, along with America, are the two most expensive markets of the world. No bull market has begun at 22 P. Bull markets start in bear markets. Bull markets do not start in bull markets. So, we are almost having valuations of developed markets, which means incremental returns of Indian markets may not be too different than many global stocks if, these stocks have sound quality and growth. And to be honest, the biggest profit pools of the world in the last 5-10 years have, come from America, not from India.
Correct.
India has struggled to grow profitability between 8 to 12%. So while we as Indians obviously will have our home country bias, will have our patriotism, but in investing, we should not be patriots. In our conduct, we should be patriots. In investing, we should be rational. We should look at, common sense way of saying that where are the right companies priced reasonably well, which have good management and which have good growth prospects. Some will be from India, some from Europe, some from Japan, some from America, some from China. As an investor, I don't care. It gives me a very beautiful diversification of country risk and currency risk. There will be periods when Indian stocks will do well and the other slice will not do well. There will be periods we will not do well, the other component may do well. So this basically just minimizes volatility and increases endurance and longevity of investing. This also will minimize returns. So if let's say Indian markets have again a blowout performance, 20p goes to 25 and 30p, maybe this portfolio will underperform. But this is meant for those investors who believe in running a marathon and want to endure for long. And I think that's why this combination of, so even today when we deploy the portfolio, around 40 rupees will be in Indian stocks, 20-25 rupees will be in global stocks. There will be a meaningful asset allocation to each component. We are not doing this just as a tax hack. I just read one of the message saying that there are many other multi-asset fund with equity taxation. Fair, there is some merit they thought to have equity tax. We prefer fixed income taxation of yesteryear because it gives me benefit to take advantage of inflation via indexation. It also allows me to meaningfully allocate money to multiple asset classes. If I wanted to allocate money only to equity asset class, I already have 14 funds in DSP, then I don't need to launch the 15th fund. But we do not have a fund where you can, in the same fund, put 20% in gold if required, 30% if required, 40% in global stocks if required. This is a fund which will enable us to do that. So I think that's a backdrop.
Fantastic. And Kalpen, before having you in the show, I was talking about the power of reading and how you can become wise just by reading. And I want to ask my audience, I think the MFDs need to have such kind of deliberating powers to convince their clients the way you are convincing us to look at the multi-asset fund by your strong logics. And all of this comes from your wide understanding of the markets. You have spent 20 years in the financial market as the sales head of the various companies. You have diverse understanding. I want to ask the audience to write a simple yes. If whether they sell the fund or not is a different question, but I just want to ask and see if 10-20 of them say yes, that do you find logic and are you convinced with the talk of Kalpen? At least I am. So I will start with yes, that the logics that you are giving is brilliant. And whether I agree or not in terms of the fund or is a very different subject. And so a lot of people are writing yes, and this is the power of knowledge. And friends, you need to read and learn, and Kalpen is so wise. And so I was talking Kalpen that why you need to meet people like you and talk to people like you and read, because this kind of wisdom is not available unless you connect with such thing. Fantastic point, Kalpen. I will move on to my next question, Kalpen. And I'm trying to play the devil's act here to clarify my own doubt and some of the doubts some more people will have, because we'll have this video on the YouTube also for the purpose of wide circulation. Kalpen, gold, as you said, 12% return in 20 years ago. But if you see last 10 years, gold did not move up in dollar terms, a little bit here and there. Mostly it's a function of inflation and maybe, devaluation of rupee in the last 10 years. is that the reason, just for inflation and devaluation, to have exposure in gold, or you are still seeing a silver lining in gold investment in the future?
Okay, so gold is very tricky. It's not an easy asset class. Unlike bonds, where you have interest income and cash flows, so you can actually value that asset. In stocks, you have again cash flows, profit growth rate, and dividends, so you can value that asset. Gold is a very difficult asset class to value. And a devil's advocate, someone like Warren Buffett says that I will never own gold.
Yes.
So I'm giving you both sides of the argument so that you make a very informed decision. We also recognize some of these nuances. But for any emerging country, what happens is, for an emerging country, all their asset class returns, ultimately, if you peg it in dollar, you really realize whether you are making money or not. And most emerging countries have, over the last 5, 10, 15, 20, 25, 30, 35, 40 years, have only seen depreciation of their currency. So for example, like I said, in 25 years, if Nifty has given 12 to 13% return, but if in dollar terms, that return would be only around 9% because currency keeps losing value. So gold actually, 3-4% of the gold returns actually come from currency depreciation. And the balance return comes more from demand supply. Actually, in recent times, there are a lot of studies which show that gold returns are not necessarily correlated to inflation. There are times when inflation rises or falls, gold has a very erratic movement. One reason for us to think about gold is, one, it gives you, for an Indian retail investor, the most tax efficient and simple way to get dollar exposure. Let's say if you want to just buy dollars and keep, you can't do that in an easy manner. Gold is nothing but a proxy to own dollar assets. So that is one of our reasons, that this gives you a currency depreciation hedge, number one. Number two, rightly, as you said, the last 10-year returns of gold is only 5%. Whereas the long-term median return of gold, let's assume even if it is 9%, that should be the expected return of gold. For gold from 5 to go to 9 will mean it will have to do slightly better than where it is right now. So in a way, it is slightly underpriced from a return potential point of view. So between gold and bonds and stocks are in a bull run right now. Gold and bonds have been in a bear market for the last decade or so from an India point of view. And what is the wise principle of rebalancing or asset allocation is, generally you own more of what is underperforming and you own slightly less of what is outperforming. So that also merits some timing from a gold point of view. Lastly, one reason, and this is again very intuitive, there is no maths or data to convince you on my third argument, is that, see, in the last 8 to 10 years, those are 8, 9, 10 ke baad, after the global financial crisis, if any small problem any country or continent had, the solution to solving that problem was, just print one button on a computer and print $1 trillion worth more of stimulus. In fact, in one of its testimony, the Fed governor in front of the Senate of US has said that printing more bonds has become very easy. We just have to press a button and make an accounting entry that we want to borrow 1 trillion more, we want to borrow 500 billion more. So now what has happened in the last 15 years world over, the total leverage of the financial system has gone up almost 7 or 8 times. So in a way, the world is looking like a very bad, if the whole world was a country or a company, and we were evaluating its balance sheet on debt to equity matrix and growth rate, you will find that growth rates are slowing, whereas debt to equity is very large. These are not great metrics. So, gold is an asset class which has remained for 5,000 years. You cannot print it by pressing a button. You cannot even print it by setting up a mine and, going down and getting gold out. It takes at least 5 to 7 years. And over the last 8, 10 years, the average new supply of gold has grown only by 1 or 2%. The supply of bonds has grown by 10 to 12%. The supply of stocks, stock ka supply kab aata hai when promoters sell, IPOs come. So in a way, paper assets ka supply has been rising, whether through stocks or through bonds. Physical asset supply has been controlled. So what you are trying to then say in a very grandmother's wisdom perspective is that this asset class has relatively better discipline in terms of demand supply economics. And hence maybe there is merit in holding some percentage in gold for a bad day. And at least historically data has shown, and now, I would urge a lot of you to read the presentations we've made. See, our presentations do not just talk of narratives and stories. We make a lot of effort to make our presentations a little bit boring, but more data driven. because many people don't like to read data. They like storytelling, they like big picture, long yarn, and all of that. We have given examples that in failing countries like Pakistan, Turkey, Greece, also asset allocation formulas have delivered better return than their single asset class like bond or equity. So, for example, Turkey has, I think, 15% return for the last decade from their equity market, but their currency itself is depreciated by 23%. So what is the point of that 15%? Their inflation itself is 19%. So their real rate of return is actually negative. And actually, so even though their core asset class has done 15, the asset allocation combination there has done 19 or 20. Now, why would a asset allocation portfolio in Turkey where equity is 15 and equities lower exposure and other asset classes are higher have done well? Because their currency has tanked so much that gold in their local currency and global stocks in their local currency have delivered superior return. Pakistan, take last 10 years. Pakistan is almost like a country every year you feel is on the brink of, unexistence. Now, in the last 10 years, their multi-asset, the same formula of multi-asset that we are having here, let's say 50, 20, 20, 20 or something like that, their multi-asset portfolio has delivered more than their bonds and stocks because, again, it is the gold exposure and the international exposure because both gets feeded through currency, through dollars. They have given superior returns because in local currency terms, their currency has depreciated a lot. So for weak countries, and assuming for 1% reason India goes to something like that in the future, we hope we will not go there. Odds are very low. But assume India goes through any currency crisis, that's when gold and international will make up. Now look at other side. Look at countries we aspire to be in terms of size, scale, being developed. So whether you look at Europe, you look at China, you look at US. Again, in these three countries, their currencies have not got decimated. In fact, their currencies have only become stronger. So there, the multi-asset fund returns are very close to their equity returns. So in countries which have collapsed, multi-asset returns are significantly higher than equity returns. In strong countries, multi-asset returns are closer to equity returns with lower volatility. So that is the backdrop. And this is possible only because of that global currency diversification, which is best earned or achieved through gold and international stock exposure. So that is where the role of gold becomes important. Now, it is very important you brought this point, Brijesh, that there are periods when for 7-8 years gold gives zero returns. It is very frustrating. The same could happen at some point in time in the future. I don't know when because you never. But then even stocks have a lost decade. 93 to 2003, India had a lost decade. The Sensex was flat. 2001 to 2009, US had a lost decade. Japan has had 3 lost decades. China has gone through 2 lost decades. So there is no country on earth where markets for are unscathed, where they don't go through long phases of consolidation. So I will not worry about these long periods of zero returns about markets in a bear market, because in a bear market, your margin of safety is very high. I will worry about these, I always keep thinking, I am at 50 now, and let's say my life is for 70, 75 or 25 saal. I wish lamba bear market na aaye. Otherwise, my money will stop compounding. But if lamba bear market aayega, then, bonds and gold will take care of it. But just because I don't want a long bear market means it will not come. That is also not true. So a portfolio like this is a design against ignorance and inability or no desire to forecast. So those of you who can forecast the future for our stock market and feel that all is going to be well, this is not a fund for that. This is for people who are slightly weak-hearted like me, or who feel that मुझे थोड़ा conservative portfolio रखना है. अगर stocks नहीं चले, 3-4 साल की मंदी आ गई, तो मेरा ego hurt हो जाएगा. That why am I? तो वो type के investors के लिए ये सही fund है.
Fantastic. I think, Kalpen, you are a reservoir of data analytics and wisdom, and I'm glad that we are doing this. Fantastic viewpoint. A lot of takeaways for me personally. I'll play one more devil act, Kalpen. Sure. And friends, if you have any question, please write to me in the chat box, or in fact, I will prefer it to be in the Q&A box. And so we will take a couple of questions for Kalpen to answer. Kalpen, all of us agree that in the long term, equity gives higher returns. Of course, with volatility.
Yes.
And for reduced volatility, we have BAF. Yeah. So you keep shuffling without tax implications. So one of the things you said that, a multi-asset gives the tax implication, favorable tax implication to international equity and gold. In the same way, BAF kind of a product, a very well-established product in the country in the mutual fund space, gives you a very good hedge in terms of asset allocation of debt and equity without any taxation. Long-term returns have been decent. If somebody wants to invest for 20 years, equity is the thing. If somebody wants to invest for 2, 3, 4 years, 5 years with lower volatility, BAF is there. Where do you fit multi-asset?
So let me first qualify that the first BAF of the country was designed when I was a trainee in Prudential ICICI in 2006, 7, 8, around that period. So we were the first people who designed, and then Naren took it to a different level, and great compliments to the team at Pruai. I still have a lot of pride that that fund has become so large, and it created a very powerful category. While BAF is definitely not for 2, 3, 4 years, as it has been perceived in recent times, because in recent times, every year stock markets have really made money. But anything which has equity should need minimum of 5-year horizon. And normally, I always look at, whenever I have to decide for an asset class, that what will be its worst case return. I never think about best return kitna banega. As a risk management technique, my first question is that if I want to invest in equity, what is its worst case return on a rolling 1 year, 3 year, 5 year, 7 year basis? Data shows that even up to 5 years, equity for brief periods of time can give negative return. And in such periods, even a BAF can earn far lower return than expected. So normally, you're right, 10 years and above for equity. I would say 5 years and above for hybrid fund. And that hybrid can have different degrees like equity and bond, BAF. All of them are more or less cut from the same cloth. The numbers will. So BAF is a brilliant category. There's no denial to that. And you can continue with it when you do BAF. You don't have to necessarily change anything. Where does multi-asset, the way we have designed, come in is the two asset classes which dynamic asset allocation funds don't invest in, which is gold and global stocks, get introduced here. And again, more so in recent times, these two asset classes have lost tax efficiency, which is where multi-asset brings them back in the investable universe through tax efficiency, number one. Number two, in case of if you look at BAF, the long-term return. So there are two asset classes: equity and debt. Equity, great long-term returns. Debt, very average long-term returns. The long-term returns of debt over 25 years is around 8%, and long-term returns of equity is around, let's say, 13%. So the gap is very wide. On the other hand, when you introduce gold as an entry, its own long-term median return, I'm using the word median, so I'm not taking exaggerated outcomes. Its own long-term median returns have been better than fixed income. Historically, they've been around 11%. I don't know whether in the future they'll be 11 or not. But my hope is that between 8 and 11, so instead of owning bonds, if I add some flavor of gold, most likely it may earn slightly more than gold. So that gives me some buffer. Number two, its own correlation to equity is negative, whereas debt's correlation to equity is low. It's not negative. So gold behaves in opposite direction, and that is the power. It brings more anti-fragility than what gold can bring in. Global equity is as volatile as equity as an asset class. So it's not something which reduces volatility. It marginally, reduces the path volatility, because there are years when India does well, Europe and US may not have done well, or vice versa. Last year, India, we are all, let's say, talking about the India story and more bullish about India. And more so last year, the headlines and narratives for India have only strengthened. And exactly in the last year, Europe has been a continent of decay and collapse. But you'll be surprised to know that European markets have gone up by 24% in last year, and Nifty has gone up between 9 to 11%. Now, these things just happen without telling us. So that is the advantage of introducing global asset class, because its own potential return as an equity component will also be 2-3% more than fixed income. So what we are doing by adding these two asset classes, we are optimizing the fixed income component slightly better, because in the very, very long term, fixed income will only give the prevailing interest rates, which are 7.5 to 8%. But stocks and bonds may end up delivering 2 to 3% more than fixed income and add some value. At the same time, cutting volatility, sometimes as much as fixed income, sometimes more than fixed income. And there will be phases, it will be worse than fixed income. When, let's say, gold gives negative returns for few months or quarters, it will add more volatility. So I think it is a one-stop ऊपर का product over DAF. I am using the word DAF because हमारा fund DAF है, BAF नहीं है, तो मुझे किसी और को market नहीं करना है. But it will be one step upper in terms of volatility as well as expected returns.
Fantastic point. Fantastic. I mean, I'm getting sold on your ideas.
My intent is not to sell. Honestly, my intent is
Of
to inform, and I want people to buy the product, and I'm okay if they don't buy, as long as the decision is conscious and they understand the idea.
And that is the beauty which MFDs also need to learn, that they need to be so robust with their data points and subject matter in front of the client. Whether they buy or not, they should be convinced at least. And this is what you have done. Kalpen, I distinctively remember one of your tweets in which you mentioned that it takes 25 years for an investor to understand that money compounds in 20 years. This one line statement is brilliant. I want to ask you, we are running short of time and we'll have a couple of quick question, but this is my final thing. For MFDs, if we were to give this kind of one-line advice and wisdom to MFD, how to grow in life, how to become more successful, what that can be from Kalpen?
So to be honest, I have great respect for all of you, because you could have very well worked like me as an employee in any organization, and you may have done as well or reasonably well without, taking the struggle and the trouble of having volatility in your businesses and not getting a steady cash flow. But you have all chosen to be MFDs because you have the courage of entrepreneurism. So I am no one to advise you, to be honest. I always take this with a lot of responsibility that you guys are doing a more difficult job than what I am doing, and you know more than I would know. So my input on this question comes from an answer given to me by the top 3 MFDs of the country, who independently, I asked them this question, and all 3 independently happened to be, 3, 4, 5,000 crores and above over a period of 20 years. And all 3 of them said the same answer to this question, that what is your secret source of success? So I think all of them told me that our first, focus area is acquire customers. Second is don't lose them once you acquire. And third is survive bear markets. So if my AUM can survive bear markets, what will happen is so here now I'm adding my dimension, because otherwise aap bologe maine kya value add kiya?
Perfect.
Let me add some. So I look at this mathematically, that your AUM is equal to NAV into units. And NAV fluctuates depending on bull market or bear market. So when you are in a bull market, NAVs are high. Generally, this too shall pass. Hamesha yaad rakhna chahiye. There will be a phase when NAVs will also fall. And if I were to ask you that if NAVs fall by 20%, how much will your AUM fall by? Most people will say 20. Actually, the answer is 35 or 40. Because when NAVs fall sharply, a lot of investors also redeem. Even the units fall. Whereas the formula we want is that on fall in NAV, we want our units to rise, which typically happens when you do dollar cost averaging, rupee cost averaging, or you are able to rebalance more. So coming back to the wisdom that these 3 very veteran advisors or mutual fund distributors told me, is that normally our first principle is that we spend a lot of time in client acquisition, so much so that we spend, Nick Murray has said this also, that your face time with customers should be 10 times more than your face time with manufacturers like DSP or any other mutual fund. Typically in our industry, I've seen more people do the opposite. Face time with manufacturers is far more. Face time asking questions on market ka lagta hai is far more than face time with customers. So the successful guys have great face time with customers. Number 2, once you acquire them, do whatever it takes not to lose them. Because if your customer remains for 5 years, most likely he will become your employee. Because he will give you 5, 10, 20 more customers. And if he's an happy investor, I've seen that very successfully with almost all successful advisors. And for them to not lose customers, the customer should not lose too much of capital in the first 1 or 2 years. If in the first 3 years his portfolio broadly, behaves well, does not see very sharp drawdowns or correction, that customer most likely ends up being a medium to long-term investor. But if in the first 2-3 years itself, we have sold him aggressive products or products where there can be sharp corrections or drawdowns, कुछ हमने कोई NFO आ गया, कोई theme आ गया, कोई बहुत popular theme अभी चल रहा है, उसमें डाल दिया और for some reason 20% गिर गया. Generally, the risk of losing that customer, his trust, and potentially 5 other friends he would have given us comes down. So coming back, summarizing just 3 things: add more customers, don't lose customers, don't lose their NAV in the first 3 years. That's it.
I think this is icing on the cake of the talk that we had today. We have just, and I know that I'm eating away your time to family because I can see you are in office because of that.
That's not an issue.
And so we'll just take a couple of questions, Kalpen.
Yeah, there are a few questions. Let's do that.
Pick up in the Q&A box. And your international investment will be done in individual share picking or through fund?
Okay, I'll answer. So it will be a combination. See, we actually, we already have a fund. It is one of my favorite fund, but which is not very popular because for some reason it's not popular. I don't know why, but my second largest investment in DSP is in DSP Value Fund. And this fund basically is a fund where 65, 70 rupees is in Indian companies and 35 rupees is in a combination of Berkshire Hathaway stock and a few other similar managers like him globally. So we get exposure to global companies like Louis Vuitton, Hermes, Diageo, Heineken, Nintendo, Microsoft, a couple of great pharma companies, Novo Nordisk and LVMH. By the way, these are two companies which have just recently moved in the top 10 market cap of the world. So our value fund has done this for 2.5 years now. What we are just adding to the value fund is gold and bonds. So the multi-asset fund will be nothing but the value fund plus gold and bonds in a way. And hence the global component will be, we are open right now. If we get good stocks, we may pick up good stocks. Berkshire will be a dominant stock in the portfolio because he is a veteran investor. It is like Warren Buffett working for us free of cost. मुझे उसका share खाली खरीदना है. Either way, not many people know, but in 25 years, Berkshire Hathaway stock has compounded by 1.5% more than Nifty. So we all very easily share quotes of Berkshire Hathaway or Warren Buffett, but we rarely invest in that. So we thought we will design a fund which can have meaningful exposure there. Plus, we may have some ETFs or some global funds. Depends, but they will all have to follow two principles. The underlying companies should be high quality companies, which means high ROEs, reasonable growth, and they should not be very expensive. So, reasonable quality at reasonable valuations. That will be the formula for Indian and global portfolio.
Okay, DS Chawla, this question was from Mr. Gyanchand. DS Chawla, short answer because I want to have 15 seconds.
Yeah.
If this philosophy has so many advantages, Kalpen, why has it taken so many years to come up with this?
So we started with this 3 years back. I told you, like India and global, we did 3 years back to our value fund. In fact, in the last 4 years, most of our thematic funds also have a 20% slice of international. Our healthcare fund has 20% global stocks. Our natural resources are 30% global stocks. Our value has 30% global stocks. Initially we would have thought of launching gold separately, but now that the tax efficiency is lost, that's why we are blending it together. And better late than never.
Ashik Abrar, what is different between multi-asset of other fund houses and yours? People are inclined to invest in MAF of fund houses that is doing good in BAF.
Fair point, and rightly so. Our DAF/BAF is a very conservative design. We largely anchor around valuations, and like I said, in the last 7 years, Indian valuations have been generally higher than what they deserve to be or what they should be. So our portfolio in DAF has been generally 5 to 20% lower than the average of others. And this being a bull market, our exposure to equity has been relatively less. Now, this is not an excuse. All of you had a choice to invest in other funds, and you would have earned 2% more or 3% more there. Ours has been a more defensive design, and we keep debating whether we should change the design just at the peak of a debt bubble in the rest of the world. And just when interest rates, which had crashed to 0, have now suddenly, started moving to 4. If US interest rates move from 4 to 5 to 6 to 7, if at all something like that happens, most likely our DAF will do well because it is conservative and purely valuation respecting. We do not have any human or manual intervention to add 5 or 10% more because markets are doing well. We keep thinking, should we do that? Should we not do that? But if you just think of sound principles, we've not added pragmatism to the fund, to be honest. There is a debate internally, should we add pragmatism and make it a bit more aggressive? But I have learned one thing over 25 years, that the best time to tweak a fund is when it is doing very well, not when it is not doing very well. Having said that, in the last 1 year, average of most BAF returns are between 9 to 11%. DSP DAF is somewhere around 10%. So, last 1 year return, in fact, all our equity funds, barring the mid-cap fund and small-cap fund, all our equity funds have delivered between 2% to 5% positive alpha in the last 1 year.
Fantastic. Will you invest in REIT, Satya Prakash?
Yeah. So the portfolio, the offer document is enabled for REITs because generally when we, design an offer doc, we enable it to keep it open. Otherwise, every time SEBI then asks us for, going to investors and take permission if you want to make any tweak. But to be honest, India only has 5 or 6 REITs so far. These REITs, some of them don't even have clarity of governance. We don't even know their cash flows and stuff like that. And one of the theses for REITs is that they should do better than bonds. But in the last 3-4 years or two years that they've existed, a lot of them have actually seen capital erosion. So they are behaving more like stocks and not at all like bonds and REITs. It was always felt that they will hedge against inflation, they will hedge against rising interest rates, but doesn't seem to be so far. We are also in our learning curve. We are not in a hurry to put money there. It is enabled. As we learn more, as we get more confidence, we'll take a call.
Lot of questions, but time is running out. I will end this by quoting Mr. Sudipto Sen Gupta. He said, "This is the reason I did not go to watch Jawan. This has been an enriching experience. Lots of takeaways, multi-asset noted, but my takeaways are the other nuggets too." Thank you, Mr. Parekh. And with this, thank you so much, Kalpen, for being here and spending some quality time with us and making us a little more wise in our understanding of the financial markets, asset allocation, and all the very best to you, your company, and the multi-asset NFO.
Rajesh, thanks to this forum, I got to see you and say hi to you after many, many years. So thank you to all of you.
Pleasure.
And have a nice weekend, all of you. All the best. Thank you. Bye.
Bye-bye.
See you. Good day. Bye.
Bye.